Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings. Today, we're diving into a report from Getty Images. Get ready for a story involving refinancing, interest rate hikes, and potential debt exchanges. It's like a financial thriller, but with more spreadsheets and fewer explosions. This is an 8K filing which companies use to report major events to the Securities and Exchange Commission, or SEC. Think of it as a corporate breaking news alert. In this case, Getty Images is telling everyone about a big change to their debt situation. Scroll date of report, date of earliest event reported. Span ID equals XDX 905 EDA document period end date C 20,250,221, 20,250,221, Z FCOC 3J HSY February 21, 2025/non-numeric/scroll. The date of the event that triggered this report was February of 2025. So all this happened around that time. The company we are talking about is Getty Images Holdings, Inc. The main event is that Getty Images made a deal, a material definitive agreement, that significantly changes how it owes money. That means this agreement is really important to the company. Getty Images changed their existing credit agreement, their loan agreement, through something called the refinancing amendment. Refinancing is like taking out a new loan to pay off an old one, often to get better terms. They had an old loan agreement called the existing credit agreement, and now they have a new one called the amended credit agreement after the change. This refinancing amendment involved getting new loans called Term B1 loans. These are split into two types, one in US dollars and one in euros, which is the currency used by many countries in Europe. They got $580 million in US dollars through dollar fixed rate Term B1 loans, and $440 million in euros through Euro Term B1 loans. That's a lot of money in either currency. The money from these Term B1 loans, both the dollar and euro ones, was used to pay off the old loans Getty Images had, so they replaced their old debt with this new debt. These new loans, the Term B1 loans, are due in February of 2030, which is when Getty Images has to pay them back. That's several years away. However, there's a catch. If Getty Images still owes a significant amount of money on some older, unsecured notes, then the euro loans might become due earlier, about 91 days before those notes are due. The dollar loans have a fixed interest rate, meaning the rate stays the same. Initially, it's 11.25% per year, which is called the initial fixed rate. But the interest rate can go up. It's set to increase to 12.25% later in 2025, and then again to 13.25%, which they are calling the maximum fixed rate. That's a pretty high interest rate. There's a way for Getty Images to avoid that higher interest rate, though. If they do something called a permitted debt exchange offer and it works out, they can keep the lower initial rate. This permitted debt exchange offer basically means offering lenders a chance to exchange their dollar fixed rate Term B1 loans. This exchange has to happen on or before the end of 2025 to keep the lower rate. If it happens later, they are stuck with the higher rate. The dollar loans have to be paid back in full when they are due at maturity. The euro loans have a different interest rate. It's based on something called the adjusted euro-dollar rate plus 6.00%. This euro-dollar rate is based on Euribor, which is a benchmark interest rate in Europe. So the interest on these loans can change. Getty Images has to start paying back the euro loans in smaller amounts every 3 months, starting in June of 2025. This is called amortization. If Getty Images wants to pay off the dollar loans early, there could be a penalty called a prepayment premium. This penalty depends on when they pay it off. If they pay it off within 4 years of the deal, there is a penalty. If it's within the first 2 years, the penalty is based on the initial prepayment premium. And if it's after 3 years but before 4 years, the penalty is 2.813%. After 4 years, there is no penalty for paying it off early. Scroll the second anniversary of the amendment effective date/scroll. The euro loans also have a prepayment penalty if paid off early, but only within the first 2 years. It's based on the initial prepayment premium if they pay it off within the first year, and 1.00% if they pay it off in the second year. However, if they prepay the Term B1 loans as part of that permitted debt exchange we talked about earlier, there is no prepayment penalty. If you want all the details, you can check out the full refinancing amendment, which is attached to this filing as Exhibit 10.1. Getty Images also issued a press release about this refinancing amendment. You can read the full press release as Exhibit 99.1. So what does all of this mean? Getty Images has refinanced its debt, replacing old loans with new ones. The new loans have different interest rates and some of them could increase soon. There are also penalties for paying off some of the loans early, unless they do a debt exchange. This is a complex financial move that could save Getty Images money in the long run or cost them more if interest rates go up. Now let's put our decoder hats on. What do these moves suggest about Getty Images? On one hand, refinancing can be a smart way to lower borrowing costs and free up cash. Locking in fixed rates can be a way to lower costs when the rates are already going to be very high to prevent them from being even higher later on. On the other hand, taking on more debt, even at a lower rate, increases their financial risk. The variable interest rate on the euro loans could also become more expensive if interest rates in Europe rise. One of the biggest factors to consider is the debt exchange offer. Getty Images is clearly trying to avoid those higher interest rates on the dollar loans. If they can successfully exchange the debt, it will be a big win for them. But if the lenders don't agree to the exchange, Getty Images will be stuck paying those higher rates, cutting into their profits. Looking at the big picture, this refinancing seems like a calculated gamble by Getty Images. They are betting that they can either successfully exchange the debt or that their business will perform well enough to handle the higher interest payments. This suggests management is confident in Getty Images' future. So what does this mean for Getty Images stock? It's a bit of a mixed bag. The refinancing itself isn't necessarily good or bad, it depends on how it plays out. The debt exchange offer is a key event to watch. If it succeeds, the stock could see a boost. But if it fails and the company is stuck with those higher interest rates, it could put pressure on the stock price. The fact that they are betting on themselves by doing this could also mean that the company's direction is looking good for the near future. Based on all of this, I'd give Getty Images a neutral to slightly bullish rating. If the debt exchange goes through, there is a good chance the stock will go up. However, the stock's price is heavily depending on the decisions of the lenders and investors. Thanks for watching. If you found this corporate decoding helpful, please subscribe to Corporate Decoder for more deep dives into the world of finance.